Greetings, ladies and gentlemen. I go by the name of Toto, and I would like to welcome you guys back into my YouTube channel tutorial program where we inspire A students to achieve greatness through the mirror learning. So without wasting any more of your time, let's get straight into today's video. So today I'll be mostly dealing with our accounting equation. So we got students who are saying that they can't quite understand our accounting equation, and I believe that if you understand your accounting equation, then you mostly understand accounting. If you understand your accounting equation, okay, then you understand everything concerning accounting. So today I'll be dealing with the basics of accounting, the fundamentals of accounting. So I hope this video is helpful to you guys. So if ever you find this video helpful, do leave a like. And also subscribe if you haven't subscribed already, so that you don't miss out on any of our future content. Okay, so now where do we start? Okay, so this is our accounting equation, which is our assets is equal to owner's equity plus liabilities. So now before I get there, this is what I want to do. We'll firstly start with our DEADLiC. So I don't know if you guys know this, but then we have DEADLiC. We have this DEADLiC. I hope most of you guys know this, but then I found that not everyone knows this, but then let's do this. So if you understand this DEADLiC also, you know accounting. Understand DEADLiC, you understand your accounting equation, you know all your journals. Okay, so we'll be dealing with our journals also, which is our cash, which is our CRJ, CPJ, PT cash, all that, and then the source documents that also involved with our journal. So but then this I'll touch on later. For now, we are focusing on our DEADLiC and also our accounting equation. So I'll try to move as fast as I can so that we don't waste time on this video. So DEADLiC, I will explain what is DEADLiC, how it works, and then I'll also make few examples so that you guys can understand what's happening in our DEADLiC. And then it's up to you guys to go on and do your solid research on our DEADLiC. Okay, so DEADLiC. So we have the D. D stands for debit. And then we have the E. E stands for expenses. And then we have the A, which stands for assets. Then we have the D, which stands for drawings. I hope you know this. Then we have the C. C stands for credit side. And then we have the L. L stands for liabilities. Then we have I. I stands for income. And then we also have the C, which stands for capital. So that's our DEADLiC. This is our DEADLiC. So what you need to know about your DEADLiC is simple. Firstly is that what? Everything on the debit side, it's increasing. All the accounts under the debit side, they're increasing on the debit side. Also on the credit side, all the accounts under the credit side, they are increasing. So explain that. So simply meaning that all the accounts under the debit side. So this is the debit side, meaning expenses, assets, drawings, all these on the debit side, they are increasing. I hope this makes sense. Coming to the credit side, all the accounts under the credit side, they are also increasing. All the accounts under the credit side, they are also increasing. Income, if you see an income on the credit side, it is what? It is increasing. Asset, if you see an asset on the debit side, it is increasing. So all these accounts under the debit side, if you see them on the credit side, it means they are doing what? They are decreasing. Vice versa. If you see your capital on your debit side, it means it is decreasing. Let's make examples on this. So all these coming this side, they are decreasing. What's happening on J? All the accounts on the debit side increasing on the debit side. If they come this side, they're decreasing. everything here when it comes to the side is also decreasing. So sharp. Moving on. Let's make an example. We'll start with our debit side. We'll start with maybe let's say our assets. So we have an asset. Any asset. You can say vehicle. You can simply say vehicle. So we know that this is debit, positive, credit, negative. Okay, so vehicle is what? Is an asset. So vehicle is an asset. So assets, debit side, they are what? Increasing. Hence why you have this plus under the debit side. And then the negative under the credit side. Because if the asset comes the side, it becomes negative. Okay, so example. So let's just say here we have what? We have bank account. Let's say bank account. Bank. We have our bank. We have debit also. Then positive, because the bank account is what? Is an asset. The bank account is an asset. So that bank account is increasing. Then we can simply say credit, negative. Like this, we have straightforward. Hope so far we understand. So let me just put something here also. Let's say you have this account also. What happened? 14. So we can just say Merchant Center. So we will also be learning some of the tricks concerning Excel. So also be learning how to manipulate our information on Excel. So what do we have also? I said we have trade receivable control, trade payable control. Let's say trade payable control. So I was looking for an account that's on the credit side. So we know that the trade payable control is a what? It's a liability. Trade receivable control is a liability. So what's happening with our liabilities, Konje? Just saying 14. Then what else, Konje? Okay. Okay, so just like that. Borders, we have our borders. So if you didn't know how to do those borders, now you know. And also to expand the width of your columns, that's how you do it. Just like that. Okay. So this is your columns and your rows. Okay, but then we're not there. So we also have debit. So this is what? Trade payable. Trade payable. So trade payable is what? Is a liability. So liabilities increases where? On the credit side. So on the debit side, they're doing what? They are decreasing. So minus. Also the side, we have credit. So liabilities on the credit side are doing what? They are increasing. So we have a plus on the credit side. So we can just come and alignment. Then we align this. We write align it. Just write align. Okay, so this is what we have. This is what we have. We have our two assets. And also our liability. So two assets, they're increasing on the debit side, the liability is increasing on the credit side. Straightforward. So vehicle. What's the of vehicle? So vehicle, say for example, we have a transaction that says we bought a vehicle worth 50,000. So we bought a vehicle, our assets are doing what? They're increasing because of what? That vehicle that we bought. Yeah, okay, 50,000. So we bought the vehicle worth 50,000. So since we bought, okay, say they said we bought it cash, we bought vehicle cash, 50,000. So is that cash going to come out on the bank account? So our vehicle were increasing, so our assets were increasing by what? 50,000. Also, we have the bank account that's going to be affected because we bought this vehicle cash. So the bank account is also an asset. So what does the bank account do here? What does it do? Is it increasing or is it decreasing? Are we getting money or is money going out? So in this case, money is going out because what? Because we bought a vehicle. So since we bought a new vehicle, the bank account will be decreased. Decreased by what? 50,000. 50,000. So the bank account will increase worth 50,000. So just do this. Okay. So the bank account will decrease with 50,000. So what I meant before, so I said all the accounts on the debit side, if you see an amount on the debit side or in one of these accounts, they're increasing. For example, we have a vehicle. The vehicle, we can see we have an amount on the debit side. What does that mean? It means that amount, that particular asset is increasing. That particular asset is doing what? Is increasing. And then we also have what? The bank. Bank account is a what? Is an asset. So bank account, we see we have an amount. But where is this amount? On the credit side. So bank account, an asset when it comes to the credit side is doing what? Is decreasing. So if we see this amount here on the credit side, it means our bank account is doing what? Decreasing. Straightforward. I hope you understand this, guys. I hope you understand this. So this is simple, straightforward things. I hope you get this. Also, say for example, maybe they're saying we sold a vehicle. When we're selling a vehicle, we sold a vehicle worth what? 25,000. Let's say 25,000. Sold a vehicle worth 25,000. So our assets are decreasing. Our vehicle is decreasing. Our vehicle is doing what? It's decreasing. So this vehicle is decreasing. So we sold the vehicle. So when we sell a vehicle, what do we get in return? We get cash. So what do we do with that cash? That cash goes straight into our bank account. So our bank account will do what? Will increase or will decrease? The bank account will increase because we're getting money for what? For selling that vehicle, 25,000. Simple, straightforward. So in this case, our bank account will be increasing and our vehicle will be decreasing. Simple, straightforward. I hope so far you guys are with me. Okay, we move on. Say now we still on this vehicle. So now they're saying what happened. Now they're saying we bought this vehicle on credit. Say for example they're saying we bought the vehicle on credit. When we buy this, we bought the vehicle. Let's say we bought 10,000 vehicle on credit. So our vehicle will increase by 10,000 because we got a new asset. Of 10,000. So since we bought this on credit, our bank account won't be affected because we bought it on credit. No money left. So we said to our suppliers, give us the vehicle and then we'll pay you at the later stage. Okay, so what will be affected? Our trade payable control, trade payable control account will be affected on the debit or credit side. So our trade payable control will be increasing since we took that vehicle on credit. So where does it increase? Increases on the credit side. So we'll have an amount of 10,000 on the credit side. Double entry. So this is what they're talking about when they say double entry. Accounting, everything needs to balance. So 10 on the debit side, 10 on the credit side. We can't have 10. No. Balance. Everything needs to balance in accounting. Everything needs to balance in accounting. So once we say, for example, now we have this trade payable, isn't it? So we have this trade payables. So we owing our supplier 10,000. Say next month we decide, let's pay our suppliers 5,000. So when we're paying our suppliers, what's happening? Our trade payable control is decreasing. Our total liabilities are decreasing. Liabilities is what? The debt we have is the debt we have. So we are debtors to our suppliers. So our trade payables will decrease with 5,000 because now we are paying 5,000. So that 5,000, where is it going to come out? It's going to come out from the bank account. Bank account will decrease by what? 5,000. Reason being because 5,000 is leaving to pay what? To pay our suppliers. Double entry. I hope this makes sense, guys. I hope this makes sense. If what I've explained here still you don't understand it, just rewind the video and hear the explanations again, because we're already on 15 minutes and I'm still not done with the DEADLiC, but then almost done. I think I hope you understand this, guys. I hope you understand this. Okay, so this is pretty much what's happening. Okay, so say for example now, let's say instead of vehicle, we're dealing with an... Actually, I hope this makes sense, guys. If this still doesn't make sense, you can let me know. You can do with capital. You can make an example with capital on your own. You can do an example with capital or an income or an expense. Expense, simple expense. Say for example, we have an expense. What type of an expense do we have? Water and electricity. Water and electricity. I'll say electricity. So we have water and electricity as an expense. We have water and electricity as a what? As an expense. So now we're dealing with an expense. So this side, what can we say? Let's say income. So income expense. So here we'll have our income. We'll have our income. Not income, man. What type of income do we have? We have rent income. So we have rent income. So say for example now, dealing with our rent income. Okay, so water and electricity, rent income. So water and electricity is what? Is an expense. Let me just remove all these amounts. Let me remove all these amounts. Okay, so you can just highlight all these amounts and then you press your delete button to delete all those amounts. Okay, so let's move on. So water and electricity, rent income. Water and electricity is what? Part of our expenses. So expenses, they are increasing where? On the debit side. So hence why we have this plus on the debit side, negative on the credit side. Simple. Rent income. Rent income is part of your incomes. So incomes increase on the credit side. Credit side, we have a plus, negative. Simple, straightforward. Okay. Water and electricity. So we have water and electricity. We're paying 10,000 for water and electricity. Say, for example, you're paying 10,000 for what? Water and electricity every month. So now we are paying that water and electricity. This is when we pay that water and electricity. So our debit side will water and electricity account will be increasing. So where is this 10,000 going to come from? From our bank account. So our bank account, will it increase by 10,000 or will it decrease by 10,000? Will decrease by 10,000. So decrease with 10,000. So our bank account decreases by 10,000 because we're paying the water and electricity account. I hope this makes sense. I hope this makes sense. So rent income. A tenant is paying us what? 15,000. So let's say a tenant is paying us 15,000. So since that tenant is paying us 15,000, our rent income account will increase with what? 15,000. Our rent income account will increase by what? 15,000. So since we're receiving 15,000, where is that 15,000 going? To our bank account. So will our bank account increase or decrease? It will increase because we're receiving money. We're receiving money. Simple, straightforward. So this is simple, straightforward. I hope we understand this. I hope this is helpful. So far, if this is helpful to you, do like and subscribe, guys. The least you can do for me is to like and subscribe. Okay. So that's pretty much it concerning our DEADLiC. So you do examples with everything else I haven't touched on. Capital contribution. Capital contribution, the owner maybe contributes money towards the business. That capital contribution will affect our credit side. Drawings, the owner takes what? Inventory from the business for his or her own capital, for his or her own personal use. Also can do example with such things. But then I think that's all the example concerning our DEADLiC. So it's already been 20 minutes. So now let's get straight into our accounting equation. So let's go to our accounting equation. So accounting equation, we have asset is equal to owner's equity plus liabilities. I hope we all know this. I hope we all know this. Okay. So let's get straight into this. Let's start with this. So what do we have? Assets. We have two types of assets. We have two types of assets, which is non-current assets. And then we also have what? Current assets. Okay, so you can see this, so you can just simply fix that by double clicking. When you double click here, it will automatically fix all this. Okay, so we have non-current assets, we also have current assets. Let me go down. Okay, so let's just say 14. Okay, so let's talk about our non-current assets. Non-current assets. So what are we talking about when we're talking about our non-current assets? What are we talking about when we're talking about our non-current assets? So under our non-current assets, we have fixed assets. We have what? Fixed assets. So fixed assets. So your fixed assets being what? The fixed assets being what? Land and building. Land and buildings. And then we have vehicle. And then we have what? Equipment. Equipment. So let me just try to fix this. So when they say shade, that's what they mean when they say shade. Hey! Then let's make this yellow. Okay. And then all these can say blue. Okay, so non-current assets. So under non-current assets, we have fixed assets. So when we're talking about our fixed assets, we are talking about our land and buildings, vehicle, and equipment. I hope this is straight. Okay, so also under non-current assets, we have our financial assets. We have our financial assets. When they're talking about our financial assets, they're talking about what? Our interest. Fixed deposit, not interest. We're talking about our fixed deposit. What? Fixed deposit. We're talking about investments. Yeah, fixed deposits. You can say fixed deposit. Fixed deposits. Fixed deposit or investment. So let's just say investments. Investment. Okay, so this will be yellow. This will be blue. Okay. So non-current assets, and under non-current assets we have fixed assets, and we also have financial assets. So fixed assets, land and building equipment, vehicle. Financial assets, our investments. Investments being what? Our fixed deposits, like our interest on fixed deposit, not interest, our fixed deposits. So say for example, we go and invest money with ABSA or any other bank, or we invest with any business, that money, say we invest 50,000 with ABSA, so that 50,000 will be indicated under our investments. Hope this makes sense. Okay, so we're moving on from our non-current assets, and then what do we have? We have current assets. So we are on our current assets. So current. What do we have under current assets? Under current assets, we have inventory, and I also have trade receivables. We have trade receivables, and we also have what? We also have cash and cash equivalent. Cash and cash equivalent. So this is our current asset, so this needs to be green. And then under current assets we have what? Under current assets we have inventory, trade receivables, and then cash and cash equivalent. Cash and cash equivalent. So under cash and cash equivalent, so there are three things that affects our cash and cash equivalent. Three things that affects what? Our cash and cash equivalent. Those three things being what? Being your, what is it, Panche? PT cash, yes. PT cash. And then we have our bank. And then we also have our cash flow. Yes. Cash flow. We have our cash flow. We also have our cash flow. So these three things make up our cash and cash equivalent. So under cash and cash equivalent, we have PT cash, bank, and cash float. But then our current assets, inventory, trade receivables, and cash equivalent. I hope this makes sense. So non-current assets. So the difference between non-current assets and current assets. So non-current assets, those are the assets that you buy with the purpose of reusing in the business. So those are the assets that you buy in order to reuse in the business. And then the current assets, those are current assets. Those are assets that you buy with the purpose of reselling. So maybe your inventory. So those are assets that can quickly be turned into cash. Assets that can quickly be turned into cash. Yes. I hope I explained that well. Okay, so let's move on because we're wasting so much time on this. Okay, so non-current assets and current assets. We're done with our assets. We're going into our owner's equity. So owner's equity, what are we talking about? Our owner's equity, we have what? We have capital. And then we also have what? We have capital, and we also have drawings. And then what also affects our owner's equity? Income and expenses. Income and expenses. Okay. So we have our capital, drawings, income, and expenses. So our capital contribution. How does this affect our owner's equity? So this affects our owner's equity positively. So the capital affects our owner's equity positively. And then our drawings affects the owner's equity negatively. Negative there. And then our income affects the owner's equity positively. Expenses negatively. Simple, straightforward, simple ABC. So if there's anything, I don't think there's anything that I need to explain here. We know what is our capital, what is our drawing, income, and expenses. So I don't know if there's anything I need to explain here. I don't think there's anything that I need to explain. So this is our accounting equation. This is our accounting equation. Okay. So now we move on. Coming to our liabilities. We come to our liabilities. So we have what? Two types of liabilities. Non-current liabilities. And we also have what? Current liabilities. Okay. So this one I think I need to explain it the way I explained the assets part. Okay. So we have what? Non-current. Non-current liabilities. We have non-current liabilities. So under non-current liabilities, what do we have? We have long-term loans, long-term loans, and we also have what? We also have what we call mortgage. Mortgage. I hope I spelled it well. Mortgage bond. We have our mortgage bond under non-current liabilities. So non-current liabilities are liabilities which are payable within a long period of time. Long period of time being what? From 1 year until like 20 years. From 1 year until like it can be 2 years, 3 years, 4 years, 5 years, until 20, not even until 20, like until yes, that's a long-term loan, long-term borrowings. Yes. So you know your mortgage bond you pay it until like 20 years, sometimes it's 20 years, 30, depending on the interest of the bank. And then we have, okay, so let me just do this so that we guys, what is this? Okay. And then these two, yes, solid yellow. And then we move on. We have our current liabilities. So current liabilities, these are liabilities which are payable from the time you borrow it until like a year. So it's between when you borrowed it, it's between the period of when you borrow the money, or when you borrow whatever you'll be borrowing, until a period of 1 year. So 1 year going down, and then non-current is 1 year going up. So yeah. So what do we have? So these are liabilities. What do we have? Current liabilities. We have trade payable, and then we also have what? We have trade payables, and then we also have what we call bank overdraft. Bank overdraft. Draft. Let's spell this correctly. Is it draft? Yes, it's draft. Bank overdraft. Okay, so we all know what these are. Trade payables. You as the business, taking things from your supplier on credit, it will increase your trade payables. So we already spoke about our trade payables when we are doing our DEADLiC. All know what that is. And then you also have our bank overdraft. So bank overdraft being what? The bank allows you to use money which you do not have. The bank allows you to use money which you do not have. And then you will pay back that money with interest, of course. So that's pretty much it concerning our accounting equation. So we are already on 33 minutes. So I won't be making any examples concerning this, but I will be making another video doing a question paper which speaks about our accounting equation. So I will be making a video. We'll be making another video. That speaks about our accounting equation. So in that video, we will be applying all this that I've been speaking about here. We will be applying all this. So this that I've been doing here, I will be applying it. So I will also be coming back for references so that you guys can see how you use this accounting equation table and also the DEADLiC method. Okay, so I hope so far we are happy. If ever there's a question paper that you would like me to touch or to do concerning this topic, you can let me know in the comments. You can let me know in the comments to say, please do this particular question paper there. You can just send me the year and the semester, I think. June question paper, or is it the December question paper? Either way, yeah. So if there's anything you did not understand in this video, do let me know in the comment section so that I can re-explain that on the video that I'll be doing, on the next video that I'll be doing concerning our accounting equation. Okay, so now let's quickly do this. Let's quickly do our channels. So now let's quickly do our channels. So I'll just move quickly here on our channels. So we all know these channels. We all know we have our CRJ, which is our cash receipt channel. We have our CPJ, cash payment channel, PT cash, debtors channel, creditors channel, and we also have debtors allowances channel, creditors allowances channel, general channel, salaries channel, and then the wages channel. Makes sense. I hope this makes sense. So I know there are few which have new terms. New terms. There are few which have new terms. If I'm not mistaken. If I'm not mistaken, I think the debtors channel it's our trade receivables, and then our creditors channel it's our trade payables, and then our not trade payables. It's our so the creditors channel it's our purchase channel. I think now it's purchase channel. I think this one is purchase channel. Purchase. So I think it's the all purchases channel. PJ. So you guys will correct me if I'm wrong on this. So I'm still stuck up on the old terms. So you guys will correct me if ever I'm wrong on this. So you give me the correct new terms if ever I'm wrong on this. And then this one I think it's sales, if I'm not mistaken. Sales channel. Yeah, so the J stands for channel. So sales channel. And then the debtors allowances channel, I think is what is it? Sales returns channel. I think now it's the sales returns channel. I'm not sure, but I think the sales returns sure channel. Sales return, and then here it's purchase returns, I think. Purchase returns. Okay. And then that's all I think concerning our new terms. So if there's anything else that's different here, you will guys let me know in the comment sections so that we have the correct new terms. Because I believe that now we need to be using new terms instead of those old terms, which is our debtors channel, creditors channel, and all that. And hey, for now, let's look at our source documents that affect this particular channel. So we'll start with our CRJ. CRJ, we all know what's a CRJ. CRJ is our cash receipt channel. So meaning money coming in, all the receipts that we'll be making during the course of the financial period will affect our CRJ. The course of the month, CRJ. Okay, so CRJ, let's make this quickly. So it's 40 minutes already into the video. So I'll just write down these source documents quickly. So our CRJ, the source documents which will be having is our receipt. We have our receipt, our CRR. So CRR being what? Your cash register roll. And then we also have deposit slip. And then we also have bank statement, I think. Bank statement. So I'll just say PS, bank statement. So these are the source documents for your cash receipt journal. These are the source documents for your cash receipt journal. And then the source documents for your cash payment journal. Source document for cash payment journal is what? Your check. Check counterfoil, I think. Counterfoil. Yes. So your source document is your check counterfoil. PT cash. So PT cash, we have a PT cash voucher. Yes, PT cash voucher. And what we have our debtors journal or your sales journal. So debtors journal, we have, I think it's a duplicate. duplicate invoice. Invoice. We have a duplicate invoice. Duplicate invoice. So when a customer comes and buys, we give the customer the original invoice, and then us as the business, we keep what? We keep the duplicate invoice. Okay, makes sense. And then our creditors journal, it will be our original invoice. Original invoice being what? When we go and buy from the customer, when we go and buy from our supplier, actually. So when we go and buy from our supplier, the supplier will give us what? The original invoice. And the supplier will keep what? Will keep the duplicate invoice. So I hope this makes sense. Okay, and then we have what? Our debtors allowances journal, or as we call it now, our sales return journal. So this sales return journal will affect our credit note, and then our creditors allowances journal. So debtors allowances journal. So debtors allowances journal is simple terms means when the customer returns whatever they've bought from. If the customer bought something from us and then that customer returns whatever they've bought from us, we'll give them the credit note. And then us as the business, when you go and return things to our suppliers, so the suppliers will give us what? Will give us a debit note. Debit note and credit note. Hope you understand that. And then we have our general journal. So general journal, the source document will be our journal voucher. Journal voucher. And then we have also memorandum. And then I think we have one last thing. I think it's narration. I can't quite recall, but I think it's narration. You guys will correct me on the comment section if I'm wrong here. You guys will correct me. Narration. You guys will correct me on this one. Okay, but then one thing I'm sure of is our journal voucher and our memorandum. Okay, so moving on, we also have our salary. So this one can just merge these two, because for our salaries journal and our wages journal, source document is simple. The pay slip. This will be our pay slip. So this is going to be pay slip. So let's say this. Yeah, so this will be our pay slip. So this is everything concerning our source document. So this is everything concerning our source document. Okay, so I will also, on the next video that I'll be doing, where I'll be doing our where I'll be doing our accounting equation, I will also be dealing with our source document. So you'll see how this source document is applied in your exam, how the questions are being asked in the exam. So I think for now this is more or less everything concerning your accounting equation and also your journals. So if ever this video is helpful to you guys, please, the least you could do for the guy is to just leave a like, simple like, or subscribe. Just leave a like and also subscribe to the video if ever this video is helpful to you guys. That's the least you could do for me. So I think that's pretty much everything. So from me to you guys, this is goodbye for now.